Hey, Mike Swanson. I'm going to talk about the stock market, give you my overview for what's going on in the market, where I think things are going, and then give you my strategy for how I want to try to make money in it and why I think there's actually some great opportunities ahead of us in the market to take investment positions. First, I want to tell you that there's lots of emotion in the markets right now. I get emails all the time from people, and they're starting to actually get a little shrill. Sounding. This is one I just got moments ago before I hit the record button on this presentation. And you can see, by the tone of it, how people are right now. But the thing is, I'm not getting any panic emails. Typically when the market has a bottom, I start getting emails from people asking about, should I sell stocks so I don't lose any more money and this kind of stuff. I'm not getting anything like that right now. Most I'm getting stuff from people, like normal emails where people just ask questions about stuff. But the ones that are emotional, they're kind of like this tone. And there's some where people are confused about what my take is on the markets because 2 weeks ago I did an interview with Mike Iosef where he was talking about how he got a major sell signal, an aggregate sell signal from the guests on his show, and we were talking about that, and this is only the third sell signal like this that we've had in the past 10 years. Now, personally, I think it's a valid sell signal, but I don't think we're entering a giant bear market like we did the previous two times. Instead, I think we're in the process of having a violent correction in the stock market. So I think that's what's going on. And I think that when the correction's over, it'll be a great time to buy stocks for investments in the right sectors, and go through that at the end of this presentation so you know exactly what I'm looking at there. But why not? Why don't I think we're in a huge bear market? Well, first of all, there's a couple things we haven't seen that you usually get at the start of bear markets. First of all, we haven't seen a divergence between the advanced decline line and the market averages. What happens is at the end of a cyclical bull market, usually you get several months, even a year or two, where the start market averages go up, but the typical sector and stock doesn't participate anymore. The market rally just gets led by a few stocks, and we haven't seen that happen yet. We also haven't seen an insane sentiment top. In fact, over the past two, 3 years or so, more people have been pulling money out of the market than putting into the market when it comes to the average person. We also haven't seen a tightening cycle of interest rates, which typically precedes a bear market. In fact, the Fed has remained loose with monetary policy. So those are the three things we just haven't seen. So it's in fact, we still haven't spent much time below the long-term moving averages yet. So it's my contention that what we're actually seeing is a correction, not a 2008 bear market, but instead a violent correction, which I see being similar to what we saw in 1997 and 1998. During those times, we saw the U.S. stock market pull back as global markets as a whole pull back due to debt crisis taking place in other parts of the world. In 1997, it was several countries in Asia that blew up. In 1998, it was Russia and the long-term management capital hedge fund that blew up in the United States. The Federal Reserve at both times responded by money printing. Now here's the charts of what happened then. In the 97 debt crises that took place in Asia in different countries, we saw 12 to 15% drops in the S&P 500. During the Russian debt crisis, we saw a 20% drop. And I think the crisis now is playing out similar to what happened then. I actually remember August and July that year, the market was practically down every single day, and you saw panic drop, and then a bounce, and then a final drop as Russia defaulted, and the market formed a double bottom and then took off. The Fed lowered interest rates and printed money. And if you were trading back then, you can certainly remember the results afterwards. But this is, I don't think the market's going to take off like it did in 1999. But the point is, we're seeing a debt crisis taking place in other parts of the world, not in the United States, in a correction everywhere. Now, we've also seen corrections timed with bad debt news in other parts of the world in the past 2 years. If you recall the flash crash of 2010 and then the fall correction last year, both times we saw pretty much 15% to 20% declines in the market averages. And now, and also, importantly, those corrections kind of took two steps to them. The initial drop, and then a sideways stabilization phase. And during that sideways stabilization phase, bearish sentiment in the markets grew to the point where there are actually more bears than bulls in Investors Intelligence Survey. And once it reached that point, that was the turning point in the market. And I think something similar is going to happen over the next couple months. Right now, though, there's still more bulls than bears. You can actually see that in that email I got where that guy was saying he thought everything's overblown. He's actually getting angry at me for being negative on the market. But that's just one example of many emails I get. It's just the most recent one and kind of hyperbolic. Well, there's a second thing going on too, which I think is real important to point out to you. And there's been a pattern of rotation in the global markets over the past 4 years that's been a backdrop to what's been happening here. And that rotation is follows. The action in gold has tended to lead the action in the broad market in the United States, and so has the action in China and emerging markets of commodities. In other words, those sectors have tended to top out before the U.S. has done so, and then at important bottoms, they've bottomed out ahead of the U.S. too, and outperformed, and then peaked out and followed and led things down. So, for example, before the fall stock market crash, gold stocks topped out and dumped before the fall stock market crash. China actually topped out a year before and lagged. So you see underperformance in gold in China and emerging markets, shipping stocks, commodity-related stocks, before the U.S. market dropped. Now, what's interesting is they formed positive divergences also as the U.S. market made a new bottom in March of 2009, the final bottom for that cyclical, that last bear market. These sectors were actually going up. And then once everything turned around, they took off. China almost doubled from, as the U.S. stock market went up. Now, here's what's important for now. These markets have started to underperform over a year ago. Shipping stocks topped out at the beginning of 2011. Gold stocks started to underperform at the beginning of 2011. They made a final peak in, I think it was September 2011. Shipping stocks have completely crashed. The emerging markets ETF has done poorly too. Of course, Europe has done poorly. And what's basically happened since the October bottom, really since I think the beginning of 2011, was we've seen risk leave the global markets as a whole and flee into U.S. assets, into U.S. stocks and U.S. Treasury bonds. And that's why, even though more money has come out of the market than come into the market, the U.S. stock market, from American individual investors who've been pulling their market out, despite that happening, U.S. stocks have gone up. And the reason why is because money's been leaving foreign markets and coming into the U.S. as a safe haven, because it's Europe that's suffering from this European debt crisis, which is the epicenter of that is now Greece and Italy and Spain and Portugal are the sideshows. So that's the risk-off trade that's been going on. And as that trade continues, at some point, people will also, I believe, panic over U.S. stocks, and there'll be a surge out of U.S. stocks into Treasury bonds. The money's flowed from Europe to U.S. stocks, and I think it's going to flow into bonds as we get to another phase of this correction that I believe we're in. And the fundamental drop background of the correction is the Euro-Greece debt crisis. This is the Greek stock market, which has fallen from almost, about 90% from a 5,000 peak for its stock market to down below 500 right now. And I'm going to talk in more detail about Greece. I'm going to tell you, I think Greece is going to default. If you go right now and read articles on what's going on there, most people are going to tell you that they don't think Greece will default. And the argument they make is that, and this is Wall Street Research reports, Bloomberg, mainstream news, although now opinions are getting mixed. But right at the moment, there's some hope coming in. What's happened is, if you've been following what I've been saying, is we saw an election a couple of weeks ago in Greece that failed to form a governing government. So now Greece is having to do new elections in a couple of weeks, and there's an anti-austerity party that wants to abandon the so-called reforms that European bankers want Greece to do to continue to get bailout money. And according to polls over this weekend, the pro-bailout parties are in a position to possibly win the election. So that's one reason people think, well, Greece won't leave the euro. There won't be a default. Second reason is people just are saying a default would be too dangerous, so it simply can't happen. They're scared that the problems will spread to, or panic will spread to Italy and Spain and Portugal. So default can't happen. The European Union just won't let it happen. Cooler heads will prevail. Well, it's my belief it's going to happen. And the reason why, it's simple mathematics. And I don't think you can change math. I don't think anyone can make it so 2 plus 2 equals 20. 2 plus 2 equals 4. And 2 minus 2 equals 0. And 30% is 30%. And it's simple math. I think it's impossible for Greece to come out of this debt crisis now, because the interest rate on Greek bonds, Greek government bonds, is 30%. And at a 30% interest rate, it's simply impossible to get out of debt. I mean, you just can't do it. And if you look at bonds in the United States of corporations, before they go bankrupt, they pay 30%. That's bankruptcy rates, junk bond rates. So it's just math. And if you recall back in March, if you're paying attention to stuff, there was a deal done. The Greek bonds got above 30%, and a deal was done that clipped the rate back down to 20%. Well, now they're back up to 30%. I think that's telling us a deal is impossible. And really, the crisis started last year when the interest rates got to 10%. That's when you started seeing panic in the markets, the flash crash, and so forth. And it's just getting worse and worse. And all we've seen between then and now is temporary band-aids that just don't solve the crisis. So I think if the austerity party gets in power in Greece, we may see another bailout band-aid, but at this point, it's just going to put things off for another couple months, if that, maybe just weeks, and Greece is going to default. I just think that's the case. And I actually think the quicker it happens, the better. Here's my take. Greece will default. The risk-off trade will continue from last summer, and it'll continue until Greece defaults. And once that default happens, or as we approach it, I think we're going to see a panic correction in the stock market. Now, here's what will happen afterwards. And here's where I don't think you should be scared. People are saying, oh, it's scary if Greece defaults. It's like the end of the euro and Europe's going to collapse and all this business is going to happen. No, it's not. Italy, Spain, and Portugal will not default. The reason why is because, yeah, it is too bad. It would be a disaster. And Europe's not going to let that happen. So euro bonds will be created. Some sort of mechanism will be created to prevent these countries from bailing out. I don't know what the details are. I can't predict it. But I know some deal will be done. And in whatever that deal is, it's going to involve money printing. Money printing from European central bankers. And money printing from our own Federal Reserve. Why? Because as a result of the bailout, the European Union and European Central Bank will have to put together to put a firewall around Italy, Spain, and Portugal after Greece defaults. And the quicker this happens, the better, frankly, because Italy and Spain interest rates are now getting to the 6% point, and that's dangerous. So the longer the time goes on, the higher those rates can go. So it's best for something to happen, the quicker the better. Okay. Well, if the euro declines in value, the Fed will be forced to print money also in order to stop the dollar from just taking off and going up in value too, and messing up the exchange rates and causing import-export troubles for American manufacturers and so forth. Okay. Right now we're witnessing an environment of market corrections and awful corrections in gold, which have, in my view, led the market down, warned of the crisis coming. Well, if the Fed prints money and the European Union prints money, eventually what we're going to see after the end of this correction is an eventual takeoff for gold, a continuation of the secular bull market for gold and gold stocks. We're also probably going to see the U.S. stock market continue to act stronger than Europe. And we're possibly going to see strength come into emerging markets such as China, Chile, Latin America, the so-called BRIC countries, which have been weak over the past 2 years. So that's the rotation I see coming into the markets once this current correction is over. So gold is something to focus on and keep our eyes out for strength elsewhere. And I think that macro trend will last for 3 to 5 years after this debt crisis fades away. We're in like a mini style 2008 debt crisis that happened in the United States, except it's occurring in Europe. And we saw after that debt crisis passed in the U.S. a March 2009 bottom and then a cyclical bull market, which we're still in. So what happens when this crisis passes? And that's what we need to think about. Gold, like I said, gold inflation dominates. And then we get a trend of this for 3 to 5 years. And then after that trend comes to an end, way off in the future, inflation will explode. And as the debt crisis in Europe passes, which takes time, the Fed and global central banks will act. One day, way off in the future, it's hard to imagine, but they will start raising interest rates. And then we'll get the next cyclical bear market, which will probably be the last bear market of this secular bear market that's been going on since 2000. But man, that's way off in the future. It's not even really worth thinking about, because right now we got to deal with opportunities that are coming. So to lay it all out, this is what I see happening now in the market over the next couple months. Right now we're living in the first phase of what I believe is a three-step correction that's being driven by the European debt crisis in Greece. Well, the first phase, we've already gone through it and seen it. The market peaked out in the United States. Now the question is, are we going to get an oversold bounce? And most likely we will. Probably even right now. And if we do, I bet you a lot of people, all this stuff I'm talking about, I'm going to get lots of naysayers. Just like that email I just got moments ago where they said this is all overblown. That's what people will think if the market turns up here and bounces. But I don't think that's the end of the correction. From a technical perspective, the reason why is most of the corrections we've seen, heck, for the past 10 years, have ended with panic in the market. Panic selling, a big jump in selling volume, a spike in the VIX, a spike in the put-to-call ratio, the VIX going to 30. We've only seen it get up to about 25. So I don't think we've seen the type of selling yet that comes then in corrections. That's one reason I'm pretty confident in my opinion here. With that said, to get that type of selling, we need to see a second leg down in this correction to bring panic into the market. Well, that's what I think will happen. Well, maybe we'll get a bounce here, then a couple weeks after that, boom, the second leg down comes, and that leg could even take the S&P 500 down to the lows of last summer, around the 1100 area. And it'll probably, once that second leg down ends, it probably actually coincide with the final end of the Greek debt crisis, or the bottom of the Greek stock market. I think we'll actually see a crash in the Greek stock market. And I'll talk more about Greece and as these things kind of play out. And we'll see probably a final spike in Treasury bonds and the final low for U.S. interest rates. And I'll talk more about that too as time goes on. And we'll also probably see the final bottom or end for this gold stock correction. And it may not even come from much lower levels that we've seen already for gold. We're actually starting to see some strength come into gold and gold stocks. And we may see a continued divergence or a beginning of a positive divergence in gold and the rest of the market, which would be remember how I talked to you a few minutes ago about how gold and gold stocks tend to lead the action of the market. So if we start to see them diverge in a positive manner as the market correction continues, that'd be a powerful sign that we're at the end of the gold stock correction and it's time to load up. You know, a month ago I tried to take a stab at investing in gold and gold stocks, got stopped out. But what I was saying back then about my long-term view of them hasn't changed at all. So after that second leg down comes to an end, we'll probably see sideways action for the broad market averages and stabilization and bearish sentiment grow. And then, as I said, some sectors will diverge away. And then after that final third phase ends, the broad market will begin a sustainable rally. Not just a bounce like we're likely to get now, but a rally up to the highs and most likely even beyond them. So here's how this works out on a chart. Now, what I've drawn here, this isn't supposed to be, I'm not like an Elliott wave theorist that tries to predict the exact price points or the exact way things are going to go. I just think of things in phase 1, phase 2, phase 3, and with that in mind, here's a scenario of how that could play out. Just a way to think about things. I'm not trying to predict exact price movements of the market. I just know what I'm looking for to make me want to take investment positions. Trading and investing are two different things. You know, what I'm speaking to is geared to entering positions to buy and hold them for years. Trading is you can be in for 3 days or weeks or months even. And right now, traders may want to play a bounce, but I'm not talking about that. I'm talking about the end of the correction that started here, not like a bounce up to here. The TV obsesses with what happens on today, what's coming next week. I want to think months out, and in that case, the phase 1, 2, 3 model, the way I want you to think about it, we've had phase 1, we're probably going to get a bounce. Phase 2 would be a breakdown. People get convinced, on a bounce that the market, hey, we bottomed, the correction's over, I'm going to buy. And then if the market makes a new low and breaks down, those people panic. The guy that sent me the email earlier, convinced that, this is a great market, he's not in a panic. He thinks everything's overblown. If the market makes a new low here, closes below this low, closes below the 200-day moving averages, he panics. Other people like him panic, and that brings the phase 2 selling, and that can snowball, especially if it coincides with bad news overseas like Greece defaulting or on the verge of a default. So I think that's what things are headed to. Then you get stabilization. Phase 3, where the market bottoms, we see positive divergences most likely forming Greece, we see a final bottom in Greece stocks, but probable possible divergences in gold. And then the market goes sideways and people just continually get bearish. They're just so shook up they keep selling. That's what happened here. It happened in same thing in the summer of 2010. You had the panic sell-off, and then you had people continually to get bearish. And then once the bearish sentiment overtook bullish sentiment, things took off. And that's what will happen at the end of phase 3. Well, all right, this is all great. I've been talking to you for quite some time about all this, what I think's going on. How do I plan on making money from it? All right. What's my plan? All right. I believe we're on the cusp of a great investment opportunity in Greek stocks. I've talked to you about this before. I'm going to keep talking to you about it. And my view is what I want to do is take a 10% investment position in Greek stocks when I think the Greek stock market's bottomed or certainly turned around. And my plan is to hold that position for 3 to 5 years. And I'll talk, like I said, I'll talk more in detail about that as time goes on. All right, so the plan, that's the first part of my plan. Second part of my plan, I'm looking for a positive divergence and real evidence that we've seen a bottom for gold and precious metals. And I plan on doing the same thing. A 10% core position I plan on holding for quite some time. Because I think when we see gold or the metals bottom here, I think they're going to lead the markets for years. And if you were paying attention to what I was talking about last month, they're incredibly fundamentally cheap gold stocks. I think they can go up 3 to 4 times what they are now and still simply be fully valued and not overvalued. So the potential in them is enormous. So these are 2 core positions I want to take in 2 different sectors, and that may be something I'm doing most likely right at the end of that stage 2 panic sell-off in the market. And then I'm looking for positive divergences in the individual sectors in the U.S. markets all over the world to take intermediate term positions at the end of that stage 3 stabilization phase. Once there's pretty much the same number of bears or bulls in the market or even more, then I'll be looking to do that. Intermediate term positions in this sense are ones I'd be looking to hold for 6 to 12 months. So that's my plan. I'll talk about that more in detail, but I want you to see the big picture here. All these things are little segments we'll be talking about in more detail and homing in on things. This is the mega picture of what I see happening in the market, how I plan on playing it out. In my monthly newsletter, I'm going to talk about investment positions and core positions and managing your money. Okay, so when I was talking about great opportunities to come, this is what I'm talking about. I'm not talking about, there's no conflict between that and the view that we're on a big sell signal, or these, other people have big sell signals. In my view, that's not a giant new bear market. That's a correction. This is how I plan on taking advantage of it. So, be talking to you again in more writings and in more articles and videos to come. So, thanks for taking the time. I hope you got a lot out of this. And these are the moments, the coming months, where it's going to really pay to do homework on the markets. So, talk to you later.